This is the mistake I still see a lot of the time, especially from clients who set up entities from years ago through their CPA. Their accountant, their CPA created an S-Corp for tax savings, and then they just started stuffing all their rental property, their real estate, other assets into it. It may have made sense then, or at least it seemed like it did, but today, even best-selling author and CPA and the Rich Dad Poor Dad advisor Tom Wheelwright, who's also one of our CPA affiliates through the Asset Protection Council, says it bluntly. S corps are a bad choice for holding real estate in it. It's a big no-no. So let's break down why and what to do instead. An S corporation is designed for active business income, income you earn through your work or services. Its main purpose is to reduce self-employment tax, that 15.3% you pay on active income. But rental income, that's passive by default. It's not subject to self-employment tax at all. So putting your rental properties inside an S corp gives you zero tax benefits, and worse, it creates more legal problems. Here's what happens when you own rental properties like real estate or other assets inside an S corp. You lose the ability to deduct debt finance losses. 1031 exchanges become nearly impossible. You can't have trust like asset protection trust or foreign ownership from foreign asset protection trust without breaking S corp rules, because they have to be owned by human beings. All S corps have shares, and those shares can be frozen and seized by judges. And if you ever try to take the property or the asset out of the S corporation, that's a taxable event and a nightmare. You would owe all that deferred taxation back, and it's valued at the current market value. Most people don't have that much liquidity sitting around and paying the IRS. So you end up boxed in and stuck with no flexibility, no benefits, and a higher chance of making costly mistakes. These issues usually trace back to just old school tax planning. Back then, CPAs and even modern ones trained by them often use just a one catch-all, created an entity for everything, the businesses, the rentals, sometimes even your personal assets. The idea was just try to keep it simple, save taxes, and just stuff everything into just one S corp. That's it. But the tax code is very specific about what each structure is used for. That's why top CPAs like Tom, who helped pioneer modern tax education inside the Rich Dad Poor Dad group, teaches this one core principle. Match the entity to the income type. Use an S corp for active income, use LLCs or partnerships for passive real estate. For real estate rental properties and the asset protection side, the legal side of things, the modern and legal setup looks like this. Each rental property sits in its own LLC in the state that the asset is located in for liability isolation. Those LLCs are managed under an asset management limited partnership. Your cash flow and control hub, just think of it like that. This also maintains just one tax filing. Then for higher net worth individuals, that limited partnership is owned by a bridge trust, an asset protection trust, giving you jurisdictional protection offshore when it's necessary. That three-tier framework keeps you tax, tax transparent, asset protected, and legal compliance, all aligned with IRS code 671 to 677 and 7701 without boxing you in. So if your CPA ever says, let's put your rentals into one S Corp, just tap the brakes. That advice might work for active businesses, but not for passive real estate or rental properties. If you want to see how to structure your portfolio the right way, visit our website to learn about the Bridge Trust and the Asset Management Limited Partnership System. Because remember, you don't rise to the level of your income, you fall to the level of your legal structure.